Welcome to Smart Dollar Mindset, the channel dedicated to helping you take control of your money, build wealth, and achieve financial independence through smart money habits and informed decisions. If you're new here, hit that subscribe button because we break down everything you need to know about credit, investing, and personal finance so you can make confident financial moves. Today, we're answering a question that everyone with a credit card or line of credit has asked at some point. What is a credit limit, and how do banks decide how much credit you get? Your credit limit is one of the most important numbers tied to your financial life. It affects how much you can spend, impacts your credit score, and even determines the perks and benefits you can access. But here's the thing, credit limits are not random. Banks and lenders have a specific process for deciding how much credit to extend to you, and understanding that process can help you increase your credit limit, improve your credit score, and even save money on interest. By the end of this video, you'll know what a credit limit really is and why it matters, how credit card companies determine your credit limit, the factors that influence the amount you get approved for, how credit limits affect your credit score, tips to responsibly increase your credit limit. This video will completely change the way you think about your credit cards and give you the knowledge to make smarter financial choices. Let's dive in. What is a credit limit? Your credit limit is the maximum amount of credit a lender allows you to borrow on a revolving credit account like a credit card or line of credit. If your credit card has a $5,000 limit, that means you can make purchases up to $5,000 without getting declined or charged an over-limit fee. But here's what most people don't realize, your credit limit is not just a spending cap, it's also a measure of trust. Your lender is saying, we trust you enough to let you borrow this amount, and that trust is based on your financial profile. Your credit limit plays a big role in your credit utilization ratio, which is the amount of credit you're using compared to your limit. This ratio is a major factor in your credit score. For example, if you have a $5,000 limit and carry a $2,500 balance, your utilization is 50%, which is considered high and can lower your score. The goal is to keep utilization below 30% for the best impact on your credit health. How is your credit limit determined? Credit card issuers and lenders use multiple factors to decide your credit limit. Let's break down the most important ones. 1. Your credit score. Your credit score is like your financial report card, and lenders rely on it heavily. A higher score tells lenders you're responsible and low risk, so they're likely to offer you a higher limit. Someone with a score of 750 may start with a $10,000 limit, while someone with a score of 650 might get $1,000. 2. Your income. Lenders want to know your ability to repay what you borrow. The higher your income, the more likely you are to get a higher credit limit. When applying for a credit card, you're usually asked to report your annual income for this reason. 3. Your debt-to-income ratio. This measures how much of your income is already committed to debt payments. If you have a high income but also high debt, lenders might offer a lower limit because your repayment capacity is stretched thin. 4. Your payment history. Consistently paying on time builds trust with lenders. If your record shows missed or late payments, expect a lower limit. 5. Existing credit limits. Lenders also look at how much credit you already have across all accounts. If you already have high limits on other cards, they may be cautious about giving you more. Real life example. Let's say Sarah applies for her first credit card. She has a credit score of 720, earns $60,000 a year, and has no other debt. The issuer might approve her for a $5,000 limit. Now, imagine Mike with the same income but a score of 620 and several loans. His starting limit might be just $500. This shows how important creditworthiness is in determining your limit. Initial versus increased credit limit. Your starting credit limit isn't permanent. Most issuers review accounts periodically and may offer increases if you demonstrate responsible behavior, such as paying on time and keeping utilization low. You can also request an increase, but the lender will often perform a hard credit inquiry before deciding. How credit limit affects your credit score. Your credit limit directly influences your credit utilization ratio. For example, if your limit is $5,000 and you carry a $1,000 balance, your utilization is 20%, a healthy range. If your limit is $2,000 and you carry the same $1,000 balance, your utilization jumps to 50%, which can hurt your score. This is why some people request higher limits, not to spend more, but to improve utilization and boost their credit score. Common misconceptions about credit limits. A higher limit means you should spend more. False. A higher limit is a tool for flexibility and credit building, not an invitation to increase your debt. Lenders always approve limit increases. Not true. Increases depend on income, credit history, and current debt levels. Your limit never changes. Your limit can go up or down based on your credit behavior. Missing payments or overusing your limit can cause a decrease. How to responsibly increase your credit limit. Build a strong history. Make on-time payments and avoid carrying large balances. Ask at the right time. Request an increase after 6 months of positive account activity or after a raise in income. Keep utilization low. This shows lenders you don't rely heavily on credit. Update income information. If your income rises, let your lender know. They may approve a higher limit. Risks of a high credit limit. While a high limit can improve your score if you use it wisely, it can also be dangerous. Having access to more credit can tempt you to overspend, leading to high balances, interest charges, and even debt cycles. Always remember, a credit limit is a tool, not extra income. Advanced strategies for credit limit management. Use high limits to boost score. Keep balances low on high limit cards for a strong utilization ratio. Diversify credit lines. Instead of one card with a huge limit, consider multiple cards with moderate limits to spread utilization. Monitor credit reports. Make sure increases or decreases are reported accurately to the credit bureaus. Your credit limit is more than just a number, it's a key factor in your financial strategy. Understanding how it works, why it matters, and how to manage it can mean the difference between financial freedom and financial frustration. Remember this, a higher credit limit doesn't mean you should spend more. It means you have more flexibility and a chance to strengthen your credit profile if you use it wisely. The real power of a credit limit lies in how you manage it, not in the amount itself. If you keep your balances low, pay on time, and stay disciplined, your credit limit becomes an asset that works for you, helping you build a strong credit score and access better financial opportunities, like low-interest loans and premium rewards cards. On the other hand, if you misuse that limit, max out your cards, or fall behind on payments, it becomes a liability that drags you down financially. The choice is yours. Financial success is not about how much credit you have, it's about how responsibly you handle it. Combine this knowledge with smart budgeting, saving, and investing strategies, and you'll be well on your way to building wealth and achieving true financial independence. If you found this video helpful, hit that like button, subscribe to Smart Dollar Mindset, and share this with anyone who needs to understand how credit limits really work. And don't forget to check out our other videos on credit, debt management, and investing to take your financial game to the next level.